So if someone has the ability to qualify, would you say that now is a good time to buy?
Well, I'd never say that. It's like such a cliche for the real estate
It is.
industry.
It is
So,
though.
um, I my usual spiel being the right time to buy is when you find something that you can afford and you're going to stay in that place for a number of years to smooth over, the ups and downs of the business cycle. So that's the best time to buy. Find something you're comfortable with affording.
You've landed on the Mortgage Life podcast, where we strive to bring you mortgage-related info that's easy to understand.
We have conversations with market experts to bring you timely updates because there's one certainty in this industry: things change.
I'm Mindy Bodwin.
And I'm Pete Solomosi. Welcome to the Mortgage Life podcast. So we wanted to start today. Well, I'm going to start with introducing our guest today. We've got our many-time guest, Brendon Ogmundson from the BC Real Estate Association. Thank you, Brendon, for joining us today. Brendon, can you give us a little bit of a background on yourself? I mean, you've been here a few times, so we kind of know who you are, but and maybe just a little brief history lesson on the Bank of Canada overnight rate and where we are today.
How far back do you want me to go?
I don't know, as far as you're comfortable.
Yeah,
Okay.
totally
Um,
relatable.
Yep.
So Brendon Ogmundson, I'm the chief economist for the BC Real Estate Association. We communicate sort of, at least my department communicates, trends in the housing market. And we, of course, have been diligently watching the Bank of Canada. It's a big part of our job. Of course, what the Bank of Canada does or how it communicates affects mortgage rates, and that affects the housing market. So a big part of what we do and have been doing, especially the past year, is really watching inflation and trying to figure out what the Bank of Canada was going to do eventually. So history, I know we can go back to inflation targeting in the start of like 1994.
Yeah.
Sure.
How far back? Yeah, okay. All right. So the current way the Bank of Canada sets interest rates is really based on a change in their sort of way of making policy that happened in the 90s. It was sort of this idea of it targeting a 2% inflation rate. Was somewhat pioneered by, I think it was the central bank in New Zealand, and then kind of adopted. There was a bunch of research about it too. Just some way of anchoring inflation expectations, because we've been coming out of a period in the 80s and 90s where inflation was very high. Expectations of inflation were not anchored, so like there wasn't like, and businesses and households couldn't kind of look in the future and with certainty about how their cost of living was going to change. And so the reason we have an inflation target is that households and businesses can plan for the future in a way that's like, if you have a well anchored inflation target, that what's inflation going to be next year, I don't have to really worry about. And not worry about prices spiraling out of control. It's probably going to be 2% increases, and then my wages will go up with that, and there's no reason to worry about inflation. So that's why we've set policy for a long time. It worked really, really well. There was this whole period before the financial crisis in 2007 called the Great Moderation, where we had this utopia of very low inflation and pretty strong growth. Then the financial crisis happened, and since then we've been kind of all over the place. So rates were very, very low after the financial crisis for a very, very long time. We struggled to get the overnight rate back to what the Bank of Canada kind of considers neutral. So they think there's some rate in the economy that is sort of a Goldilocks type rate. I kind of describe it as everyone buying the world of Coke, and dogs and cats living together in harmony, and Maple Leafs and Canadiens fans getting together for a beer, that kind of thing. That when the overnight rate is at neutral, everything is great. We don't spend a lot of time there. Unfortunately, they had real trouble getting their overnight rate back to that neutral rate. All through the teens, we had very, very low interest rates. They started raising rates in 2018, 19, before the pandemic hit. So they had been raising rates. I think they got up to about 175 back then from 0.5%. They had cut rates again after the oil shock in 2015. And then we had a global pandemic, during which rates fell back down to zero. And we had a lot of fiscal stimulus turns out when you have an economy that can't create any goods, and all of your spending kind of shifts to services, or sorry, shifts to goods because services aren't available either. You tend to generate lots of inflation and then switches back. So we ended up having a lot of inflation that most people thought was transitory. It turns out transitory just took a little longer. We peaked at about 8% inflation in 2022. Bank of Canada started raising rates early in what was that, 2023? No, 2022? Yeah,
22, I think.
2022. In response to inflation that was rising well above their 2% inflation target. We've had the Bank of Canada then took rates all the way from quarter of a point to 5%, where we were until last week when they finally cut rates again. So I think that's a long, somewhat abridged history of monetary policy. There's a lot of more things that happen, but that's sort of where we are right now. Bank of Canada. The really interesting thing about this, lowering cycle, it's the first time that we're seeing monetary policy or we're seeing rates fall, but not in response to like a global crisis. The last times the Bank of Canada has cut in 2020 was in response to the global pandemic. In 2015, it was in response to a massive shock to oil prices. Oil prices completely collapsed in 2015, end of 2014. Financial crisis in 2007, and even before that was 2003, and that was in response to SARS. So it's been and even then before that, 9/11. So, and the dot-com boom bust. So this is like the first time in a very long time that rates are just coming down because they don't need to be this high anymore. Again, we go back to like the idea of a neutral rate at 5%. Bank of Canada thinks its neutral rate is somewhere between 2.25 and 3.25. So it's very restrictive at 5%. So even at 4.75, it's still pretty restrictive. If they cut to 4% by the end of the year, that's still very restrictive. It just doesn't need to be that restrictive to hit their inflation target. So it's a very different situation than we've seen it sounds dramatic to say about like this century.
Right. So it sounds like the Bank of Canada is making sort of a gentle adjustment now, right? They're working in an environment
very much. That's a good way. They're sort of just trying to calibrate the economy. So, if this idea of a neutral rate gives you an idea of where they want to be long term. If they think the right range is between 2.25 and 3.25, let's just call it right in the middle. If they're going to go to 2.75, that's where they think rates should be long term. That's where they're headed. It's just a matter of how long it's going to take to get there.
Okay, and so this neutral rate, this magical area that the Bank of Canada is hopefully going to get back to. I mean, maybe not. Maybe it will change its new normal in the future. But how does this Bank of Canada adjusting their overnight rate actually impact like variable rates, like what a borrower pays? How does that impact the end user?
Right. So variable rates are priced off of the prime lending rate. The prime is always at a spread over the Bank of Canada's overnight rate. I think prime is, just what is prime currently? I pay so little attention to prime because I always just look at the Bank of Canada's overnight rate.
I think it should be after
it was 7.2 and now it's
6.95.
Okay.
That's right.
Right now, variable rates are like prime minus 60 basis points, I think, is what I've seen kind of in the market. Maybe that spread or that discount is higher or lower from some lenders, but it's around there based on the data I look at. So when prime falls, prime always falls. There was a time that it didn't. Prime always moves with Bank of Canada's overnight rate. So if you have a variable rate with a adjustable rate mortgage, then your payment would have fallen last week. If you have a variable rate with a fixed payment, which is much more common, you would have just seen you'd be paying a little more equity into your on your mortgage payment as rates fall. So going forward, I mean, if you're thinking about new borrowers, I don't think anyone's taking out variable rates necessarily right now because they're
doesn't seem to be too popular.
Situation where they're much higher than 5-year fixed rates. And even it's going to take, I think, about 7 rate cuts before they're under 5-year fixed rate. So maybe not a lot of demand for variable rate mortgages, even though the Bank of Canada is cutting.
Yeah. Hey, tell me, so we know that the Bank of Canada rate affects the prime rate, the bank's prime rates, which is how most of our variable rate mortgage clients, adjustable rate mortgage clients, HELOC clients, all those things are all affected by the bank rate. So how does this change affect fixed rates? Does it have any effect on fixed rates?
Much, much more complicated. So if the 5-year bond yield, you can think of it as like the average of expectations about future monetary policy plus like a risk premium. So it sort of is a way of gauging what markets expect kind of growth and inflation to be and what the Bank of Canada's response is going to be. Right now, the yield curve is inverted, so it's more expensive to borrow short than long. That's not the way things normally work. Most of the time, you need to be compensated for lending money for longer, right? There's more uncertainty. And so normally yield curves slope upward. So to get back to its normal shape in the yield curve, Bank of Canada's going to be lowering rates, and that's going to lower the front end of the yield curve.
Short term.
And then the sort of the 10-year yield needs to come up a little bit so that you get this upward sloping shape. The 5-year then is just kind of in the middle. It's not going to change very much at all from where it's at right now. And it's fallen significantly over the past year as expectations changed about the Bank of Canada and about global monetary policy. But it's right around 3.5%. And the average 5-year fixed rate, it's usually around about 160 basis points over the 5-year bond yield. So that implies if the 5-year bond yield is 3.5% and you add in a mortgage spread, that gets you to about just call it 5%, maybe it's 5.1, maybe it's 4.9. That's probably where we're gonna be long term. And so we've actually already priced in all of the Bank of Canada rate cuts that are expected. So even if you just think of I think there's usually about a 225 basis point spread between the 5-year mortgage, 5-year fixed mortgage and the overnight rate. So if the Bank of Canada is going at 2.75, that implies a 5-year fixed rate of about 5%. And that's where we are right now. So even as the Bank of Canada cuts, I wouldn't expect the 5-year fixed rate to fall very much. And it's influenced a lot more by things that happen in the United States than things that happen in Canada. So for example, last week, Bank of Canada cut for the first time in a couple of years. And 5-year bond yields, I think, fell about 5 to 10 basis points that day. A couple of days later, we had stronger than expected employment data in the United States, and 5-year bond yield jumped 10 basis points. Then this morning, we had better than expected core inflation readings in the US, and the 5-year bond yield fell 10 basis points. So a lot of what happens with that part of the yield curve is really determined by, we say global markets, but really US markets and what US economic conditions are. So only so much control over that part of the yield curve from the Bank of Canada.
So I'm going to ask you to pull out your crystal ball. I know this is the economist's favorite thing to do, to make market predictions.
And this is 100%
predictions.
correct, right?
Always. Please do not go back.
And we are going to quote this. No. Okay. So rate announcement coming up July 24th. Where are you going? I mean, in this conversation we've had, you've mentioned rate drops several times. You've mentioned even 7 rate drops, which implies small quarter-point rate drops. Is that kind of what the consensus is? Is that what?
Yeah, I mean, again, they're not responding to a crisis, so my expectation is that it'll be a very gradual 25 basis point cuts at each meeting. There's 4 meetings to go. My forecast since the start of the year has been that we would finish the year at 4%. So that would mean at 3 of the next 4 meetings, maybe they'll do cuts at each meeting. It really depends on what they're sort of reading on the economy and inflation. It's also like inflation is a bit of a lagging indicator, and central banks set policy based on what they think is going to be happening 12 to 18 months from now, right? So falling inflation kind of signals that inflation's maybe going to, if they had held rates, maybe inflation was going to undershoot their target significantly at the cost of some damage to the economy. So if they're seeing inflation fall a little faster than expected, or if we keep getting pretty underwhelming, jobs data, that's probably a signal to them that maybe they need to go a little bit faster. If things really firm up, maybe they can be more gradual and kind of data dependent. But my expectation is that they'll cut at each meeting going forward till they get to neutral. maybe they skip a meeting here or there to kind of recalibrate, but that's probably the best kind of baseline you could have for a forecast.
Well,
For
that's
sure.
exciting.
That is
Right.
exciting, especially for those of us with variable rates. Yes,
And
absolutely.
HELOCs.
And HELOCs. So, as we know, a journey, I guess, is it a journey of 1,000 steps, or 1,000 miles begins with a step? Every step we go through this process, we're kind of coming to the next step. And in this one, I always think, well, if the rates are kind of looking to be going down, how is that impacting the real estate market?
Yeah. So I expected more of a response from sales activity just from the decline in 5-year fixed rates because they fell from over 6% to like 5. So they fell about 120 basis points from where they peaked. Um, didn't have much of an impact in the first half of the year. We're still running at about 15% below normal across BC. Some markets a lot worse in the first half, like the Okanagan was really pretty beaten up. Some of those markets are getting back to normal. The islands looking a little better, like Chilliwack, Vancouver, and like Fraser Valley are still lagging. More like the more expensive markets. Things got real expensive really fast in 2021, and again, a market like Vancouver, they were still there was a time, like, at least for a week in May when I was looking at prices. The average price in Vancouver was back above its all-time peak that they had set in 2022. So prices haven't come down much and rates are up a lot. That makes affordability really tough. So that's always going to be a constraint. It's a little easier to qualify now, but like qualifying at 7% is still pretty tough for a lot of borrowers. So especially in those expensive markets, it's probably not too surprising that we haven't seen that much of a bump. The narrative about the Bank of Canada and markets is that a lot of the demand that we saw, kind of the pent up demand we saw, was going to be sort of unleashed once the Bank of Canada started cutting. I think that's true in to some extent. I think we will see a pickup. There are certainly probably some potential buyers that, if they were looking at what happened last year when the Bank of Canada said they were on pause and then raised rates in June and July, maybe they really just wanted to see the Bank of Canada cutting before they got back into the market, so they weren't sort of surprised by rates rising. So I think that kind of psychological barrier might bring some of that pent-up demand off the sidelines. It doesn't mean we're going to be at, huge amounts of volume. It just means things are going to get a little bit more normal, which is, we've had sales trending well below normal for a while. So normal is going to feel like a lot of activity, but I think it'd be certainly welcome to get back to more average levels of activity.
Yeah, there does seem to be a psychological element. I think maybe the fixed rates not having as much of an impact. Watching the news in the evenings, they're not talking about, oh, and today there was a 20 bips drop in the 5-year fixed rate, but they do talk about what the Bank of Canada does, and that's what the average person hears.
That's one of the things I forget is that not everybody is checking the yield curve every morning and what's going on, and most people don't have that strong an understanding of how the Bank of Canada's overnight rate relates to other interest rates in the economy. I think they just think there's an interest rate and it's controlled by the Bank of Canada and up and down. So no, I wouldn't fault anyone for not realizing that 5-year fixed rates have come down. They might instead just think rates at a certain level, see that the Bank of Canada's cut, check 5-year fixed rates, see that they're down, and maybe make that connection. I don't know. Whatever it is, I think there will be at least that kind of psychological sort of, oh, rates are a lot lower than they were last year. It must be because of the Bank of Canada. Now's the time maybe to start looking.
So if someone has the ability to qualify, would you say that now is a good time to buy?
Well, I'd never say that. It's like such a cliche for the real estate industry.
It is though.
I my usual spiel being the right time to buy is when you find something that you can afford and you're going to stay in that place for a number of years to smooth over, the ups and downs of the business cycle. So that's the best time to buy. Find something you're comfortable with affording. Best time to buy if you're an investor is now a good time to buy if you're really just looking at price appreciation. So for like the small sliver of demand that is investor driven, maybe not that small. Maybe what really it kind of depends going forward. If sales are going to really start to pick up, the fortunate thing for the wider market, those who aren't just banking on price appreciation, is that supply is actually, the supply of listings is actually getting closer to what we would consider like a healthy amount. We were, for the last several years, starved for listings. And now across the province, it's not back to where it needs to be kind of long term for like a healthy balance, but it's getting there. And there's some markets that have like a pretty close to what we would consider like a long-term healthy amount of listings. And that's just helping to keep prices pretty flat. Like they haven't really, at the provincial level, haven't changed much over the past 5 to 6 months, which is what we want. We just want, we had a lot of price growth. We don't need a lot more for a while. We need pretty flat prices, especially in real terms, just keeping up with inflation.
Yeah. No, I feel like
So
we had
we're gonna
a
have
decade.
incomes catch up, right?
We had like a decade's worth of price appreciation in
Exactly. We had like prices went up like
scary.
60% in some markets. So we need a period of like calm and where affordability can start to improve a little bit. So fortunately, we're in a place, even if sales pick up a little bit because of what the Bank of Canada is doing, there is enough supply in the market that we can probably absorb it without prices really starting to accelerate.
Okay, and then just taking a sidestep from the rate conversation, there have been some announcements to help with the housing affordability in the province. The new short-term rental rule change that is still kind of percolating through the various municipalities and how they're going to handle it. Has there been a market impact that you've seen? Will there be?
It may have stimulated some listings activity. So there are certain markets like Vancouver, Victoria, and parts of the Okanagan where we saw like an uptick in new listings. Like Victoria had their highest new listings in almost 20 years in May. Some of that's catch up. It's like last year we had the lowest year for new listings since like 2005 across the province. So some of it's just like we had no new listings last year. Maybe we're just making up for that this year. But I think in markets where you would expect it, where short-term rentals are a thing, we have seen a bit of an uptick in new listings. Whether or not that sticks around, there was also the capital gains tax thing that you had to kind of basically get your home sold this week to avoid, or maybe even sooner. So we'll see. Some of that might have been policy motivated. Some of it might just be making up for a low listings year last year. We'll kind of know in the next few months if that trend is real.
So to sum it up, I've got a two-part question for you, Brendon.
Okay.
I'm going to hit you with some really difficult questions here.
Ready.
First part is, are you feeling optimistic? And another way to word this is, I know your kids are getting to the point where they're going to be moving out. Would you want to buy them a house, or would you want them to buy a house? And the second part of the question,
the
second part is, use the name of a song or even the lyrics to describe your level of optimism.
Okay. So for songs, level of optimism. I mean, never ask an economist about how optimistic they are. Not.
It's the hard questions today.
So
I figure you could relate to this in a song.
Well, I've got three. So just because I need to keep my music nerd credentials as strong as possible, I'd go with I'm sure you're familiar with the band Volcano Suns, early 80s post-punk.
I am not.
They're an offshoot of Mission of Burma. The drummer from Mission of Burma. Then anyway, I can't believe it. Anyway, there's a great song called Balancing Act, and I think it's a great song. Go listen to it after this.
Yeah.
Maybe it'll be your new favorite song.
Maybe it'll be the background music for the episode.
Yep.
There you go. But like that is, I think, I'm trying to balance being somewhat optimistic about a lot of the policies that we have on the supply side, and our ability to keep prices kind of in check. But then I'm like 60%, I guess, optimistic that we're going to be able to do that And then the other part is like still pretty worried that a lot of the inventory we've seen accumulate is just a function of sort of, listings that didn't happen last year. And once sales pick up, that's going to run down again. We're going to be back in a situation where prices are starting to rise faster than we would like. So some balance in between there, I guess. I would like to be optimistic. I would also, if you're not into Volcano Suns, I would say No Surprises by Radiohead. So I would also like, I'd like to have like a nice boring year where we don't have a lot of surprises, where we have a nice balanced, healthy market. I think the song, I don't know if it's on the same album, but is it right after? I don't want it to be a letdown. It's also a Radiohead song from my computer, where like things get either bad in two very different ways. One being that sales pick up and inventory can't keep pace and prices start to accelerate. But then the other one that I'm worried about as well is that people start getting reset on their mortgages, and we see a lot more listings, and that would be really certainly not boring and not a fun time for anyone in the market. So yeah, any one of those. So yeah, on the optimism side, I think that generally the conditions we have right now are pretty strong. There's some risks on both sides that are going to make it difficult to kind of balance.
And here I thought you were going to say, "Don't worry, be happy." So
yeah, no,
I
I'm
do
not into
feel like
novelty. I'm not into novelty songs. So
it is a bit of a balancing act. I
Bobby-
get that. It's
Bobby McFerrin.
it can go either way very
Wow.
quickly.
Yeah.
No, that's phenomenal. Brendon, thank you again for your insights, your musical history. We're going to go check out some early 80s punk rock. Yeah, we'll have you back on again.
Awesome. Thank you. Anytime.
You're a great resource. Thank you.
Hopefully we get another rate cut in July.
I hope
Yay.
so.
When you're on vacation,
Exactly.
you don't have to deal with it.
Yeah. All right.
All right. Thank you,
Okay,
Brendon.
Thank
Chat
you.
soon.
This is The Mortgage Life.
We look forward to continuing the conversation.
So come back and listen.